right? Really, saying that you increase the valuation of your company via a private funding round is basically fancy verbiage for telling someone that you took a piece of paper and sold it to a new investor for a little more than what a previous investor paid for it. What does that mean? You know, the fallacy there is you can do that with or without actual growth.
We now move on to our next speaker of the evening, Mr. Shaumik Saha. Shaumik is a young and dynamic entrepreneur under the capacity of director at Strideplus Consulting. His expertise lies in profitably taking ideas, brands, or products to their target market in the fastest, in a most cost-effective manner, ensuring efficient project management, quickening sales processes, and strategizing exponential top-line growth. He has personally led various events, advertising, and branding campaigns to fulfill such objectives for several prominent brands in the region. A great motivator and experienced with increasing efficiency and outputs from teams across various departments, Shaumik's polite and humble demeanor attracts one and all. Let's welcome our next speaker of today's evening, Mr. Shaumik Saha. Shaumik, over to you.
Thank you, Mrs. Anju. Firstly, I must say it is both a pleasure and an honor to be able to share this platform with Mr. Raj and Mr. Andreas and Mrs. Anju as well. So, as I mentioned, we've had some great talks and some very resourceful points about several broad aspects, several areas that one must keep in mind as far as running a business or entrepreneurship is concerned. What I want to do is address a very specific aspect of the entire process, which is around funding. Okay, so let me get right into the chase and talk about how I was inspired to address this topic. It was a couple of days back that an acquaintance of mine sent me this infographic. Okay, and he shared a link to this infographic that someone had posted on social media. And I went through it. I took a look at what a lot of people were saying. And this precisely is a fundamental misconception that many people have as far as startups or business or entrepreneurship is concerned. And I'll get to what that misconception is over the course of my talk. But this is precisely what's wrong with the way a lot of people think about startups or running your own business. There's so much talk about valuation. You know, we see it all over the place. If at all anyone puts the question out there about you know, what it takes to classify your company or your startup as successful, one of the main things you hear right off the bat is valuation. Or, you know, when discussing other prominent startups and companies out there, one of the main things that you hear people bring up is valuation, right? But you know, what does that mean? Is it really all that important? Is it really an indicator of growth at all, of progress or success at all? And the answer is no. Okay, just looking at this metric alone doesn't tell you very much. For instance, half of the startups that are on this list, so this is a list of the 10 most valuable startups in the world. Okay, half of the startups that are on this list are not profitable. They lose money on every sale. The vast majority of them have been in business now for at least a half a decade or more, right? And throughout this entire period, not only are many of them not profitable, there are many of them that haven't returned any sort of yield for their investors even. A lot of them have got employees that have voiced concerns about being treated poorly, low salaries, stressful conditions, all of that. Okay, and that is what is wrong with looking at just this one metric. Okay, what happened to you know, more realistic metrics for evaluating the success of an enterprise, things on the grounds of profitability, the way you're able to treat employees, their salaries, the sort of return you're able to show to your investors or shareholders, whatever happened to all of that. And one of the biggest sort of groups of people who here as the media, because they pick up things that may sound inherent, that may sound superficially exciting. Things like, oh well, how much is the company worth, right? A big number that attracts a lot of attention. It makes a lot of people feel a certain way, right? It's a lot of money, attracts a lot of attention. But how resourceful is it really from the perspective of evaluating performance or success of that company? Not very much. And so this is one of two issues that I want to address, right? The first issue, as I've already mentioned, is what I like to refer to as the valuation mania, right? People focusing on one metric that really doesn't mean very much, okay? The second aspect that I want to address is the exact polar opposite of it, which is underfunded startups, okay? If you ask me, these are perhaps the two biggest mistakes that people make when it comes to understanding ways in which they could finance their startups, their small businesses, right? So, as I've mentioned, the first aspect that I want to address is valuation mania, right? And so there are several issues with looking at just as one metric, some of which I've mentioned before, right? Really, saying that you increase the valuation of your company via a private funding round is basically fancy verbiage for telling someone that you took a piece of paper and sold it to a new investor for a little more than what a previous investor paid for it. What does that mean? The fallacy there is you can do that with or without actual growth. And in many cases, with a lot of these startups, it seems to be the latter, wherein they haven't got actual growth. In fact, oftentimes, in many cases, you see startups that are burning more cash than they did, but they're raising money at higher valuations. It doesn't add up, right? And so, what is the issue with this, right? We look at some of the companies on this list, companies like ByteDance, or companies like Paytm in India, companies like DJI. We look at some of these companies. They're reputed, successful companies. We see their products, all over. We hear a lot of good press, a lot of good news about them. And so, an obvious question for a lot of you to ask will be, what is the problem with this? What is the problem with companies functioning this way? And the answer to that would be, these are not real sustainable businesses, right? One of the fundamental ideas that you've got to understand is that any enterprise has got to be economically sustainable, economically viable, which none of these companies are inherently. I mean, the ones that are not profitable, right? So nearly half of these companies are don't fit that criteria. They're not economically sustainable. They're not economically viable, right? And so the obvious issue there is, if we end up in a situation like what we're in now, a recession or economic turmoil, any sort of challenging, difficult economic situation, these will be one of the first companies to, not be able to keep the lights on, right? And one could debate that to a certain extent, right? We're in difficult times now, but yet a lot of these companies still seem to be doing all right, and there are different reasons as to why that is. That is a very detailed conversation that we can perhaps have later at some other time. But there is another reason as to why that is. There's a lot of liquidity, low interest rates, all of that. So there are certain ways in which these companies, despite not having very good models, are still able to sustain themselves. But ideally speaking, this is not the right approach to have. A few anomalies are fine. We've had successful cases like Amazon, but for every one of the Amazon out there, I could pull up probably a dozen companies that ended up like WeWork, for instance. Huge valuations, never made sense. The investors realized that it made sense. The company was worth less than half of what people thought it was. Okay, so this is essentially the issue with it. And on a deeper level, how does that impact employees of the company? They lose jobs. they lose morale, all of that, right? And so there's definitely a lot of negative aspects associated with running such an operation, wherein founders sort of convert this entire process of running a business or having their startup into a sort of funding game. Really, all they're trying to do is take a piece of paper, sell it to another investor for more and more and more money, right? And so they're technically increasing the valuation of their company. What does it really mean, right? Are they really economically viable models? And as I've mentioned, oftentimes they're not, right? In fact, a lot of the companies on this list are some of the very best in terms of their access to finance, and so they're able to kind of keep raising more and more money, even though they're not inherently profitable, and keep going, right? And so as I mentioned, you might say that, well, hey, they're doing fine, and yes, they are, but these are some of the very best, right? These companies are founded by very well-connected founders that got access to seemingly unlimited amounts of money in terms of finance. Their connections with investors, their relationships with finance and banking institutions, you name it. And so the problem is for most other businesses or the vast majority of other startups, this model is grossly improbable, particularly in the case of younger entrepreneurs that may not have that sort of that may not have that level of connection with investors or banks or that sort of level of creditworthiness to go out and borrow these ridiculous amounts of money, right? And so that can be tremendously demotivating. It can be a very unrealistic expectation to have. You hear a lot of news about these companies going out there and raising tens of millions, billions of dollars, and you come back to your own startup and try and figure out what the hell is going wrong. And so it's broadly speaking, there are a lot of negative effects of having a model such as this glorified, having this one metric around valuation, how much a company is worth glorified, and sort of pushing all the other aspects around financing a startup to the sidelines as if they were not important. Metrics such as profitability, ROI for investors, your growth in terms of employee salaries, and how well you're able to take care of your team. Right? It seems like all those metrics are sort of sidelined, and every time on discussing one topic around how much is a company worth. Right? So that is definitely one of the biggest misconceptions out there. As someone that is a relatively young entrepreneur that's just starting out, is still figuring their way out, what you want to do is come up with an economically sustainable model, an economically viable model. In simple English, what that means is every time you sell a product, you ought to make money off of it, right? That operation of you selling a product should not be a money-losing operation, which in the case of many of these startups or several startups out there is an issue, right? And as I mentioned, there have been some successful use cases of this, be it Amazon or some of the other companies on this list that are profitable. But that model may not be applicable to the vast majority of other startups, which is prioritizing top-line growth at the expense of not being profitable, at the expense of really not making any money, right? Amazon could do it because, again, Jeff Bezos, very well-connected founder, his access to financing is unrivaled compared to most other founders, right? The average company, the average startup is not going to have that level of access to money, really, to keep running their business at a net loss, okay? And so that is not a sustainable model for most startups in the long run. Sure, it will take a while for your company to break even, 2, 3, 4, 5 years, but to get to a point where you could be making money, but refusing to do it, prioritizing top line growth at the expense of not making much money or being at a net loss, terrible idea. Honestly, I've seen a lot of this in several companies that I've had the opportunity to consult on various different grounds, and I've seen several examples of operations such as this that have been run for years on end at a net loss, just because someone thinks that they could grow a little more. Wrong approach. What you want to do first and foremost is ensure that your idea, your concept is economically viable. You want to ensure that you're able to build a real sustainable business, right? And so another question here might be, well, what does economic viability have to do with sustainability? Well, a lot, right? Mr. Andreas mentioned several points on the grounds of social responsibility, CSR, being able to take care of your employees, being able to ensure that even as a startup, your employees have got good career opportunities and that they're able to stay employed with you for the foreseeable future. How are you going to ensure any of that if you're not inherently an economically viable business? If you're constantly losing money in the name of growth, and you've been doing it for years on end, or as a new startup are considering functioning that way, or perhaps have worked out a lot of your financial modeling, factoring in the fact that you would like to prioritize growth at the expense of being at a loss, financially speaking, you've got to rethink that, because if you do that, you're not going to have enough resources to be able to do really anything else that might be considered sustainable. You're not going to have resources to really take care of your employees. You're not going to have resources to really give your investors any sort of yield for a very, very long time. You're not going to have enough resources to fend for yourself in the case of an emergency, or if something goes wrong, right? As I mentioned, in a situation like this, granted, a lot of these big name startups, a lot of these popular startups are still able to function, and then during a period of economic turmoil, just because they've got really good access to financing. But that isn't the case for the vast majority of startups out there that haven't got anywhere near that level of access to financing. And so what often happens is they're doing well for a few years. They're continuing to grow, but with very, very small margins, reinvesting everything, not really focusing on sustainable growth, not really focusing on any sort of ROI for their shareholders, not really focusing on taking care of their employees well. All they want to do is grow, raise more money, raise more money, raise more money. What happens next? A recession comes along, boom, they're gone, because the sort of confidence that investors or financial institutions might have when things are going well in terms of lending money out to startups is a heck of a lot more than what their confidence would be in terms of in times of economic recession or economic turmoil, right? They're going to get a lot more conservative, and they're not going to throw money at startups that don't make them any money back, right? And so yeah, I think that kind of sums up my opinion of this very prominent issue that lies out there, which is we hear so much talk about simply valuations and companies that seem to be growing, but really, if you dig deeper, these are companies that haven't made money. These are companies that have no shareholder equity. These are companies that that in terms of numbers aren't really worth as much as their valuation might have you think they are, and that isn't correct. That isn't correct. That isn't correct. Not only because some of these companies could go bust, their employees could lose their jobs, their investors could lose all the money that has been invested, but also because it is an extremely unrealistic expectation for most other founders to have. I've mentioned this before. The companies that are doing this, as I've mentioned before, these are the top 2 or 3% of founders that happen to be tremendously well connected in terms of access to investors, in terms of access to money from the banks and what have you. The vast majority of startup founders, that is an impossibility. It's not going to happen, right? And so, bottom line, as far as this point is concerned, you've got to be able to put together an economically sustainable business model, an economically viable business model. All right, when you're planning your finances for the startup, when you're planning the way in which you intend to run your company, when you're pricing your products, you better make sure you're doing all of that with the goal of having an economically sustainable and economically viable business. I've spoken on quite a bit about companies that go out there and simply keep raising more money than they really need, and really all they're doing is burning cash. The polar opposite of that is underfunded startups. Okay, so these are startups that really haven't got enough money to keep the lights on. Okay, and so what are the problems with that? Well, right off the bat, you're not going to be able to spend money that is necessary for some very critical operations pertaining to your business. Or if you're underfunded, you're not going to have money for basic critical operations. Not enough money to promote yourself, not enough money to market yourself, not enough money to develop your products further, not enough money to hire the right people. You're not going to be able to grow, right? And so oftentimes the type of founders that put together such companies are really founders that are unrealistic to a certain extent, right? Or they might not have enough money and they're just in a hurry to get started. Yes, to a certain extent, you can put in sweat equity, you can put in your own time, you can have dedicated founders that put in as much time as possible. But at the end of the day, there are certain things in terms of being able to develop good products, and in terms of being able to advertise yourself and promote yourself as much as necessary that cost money. These are things that are necessary. These are things that cost money. And if you're not in a situation to be able to afford this, or if you're not in a situation to be able to invest in these operations and these aspects, you're going to be missing out on a ton of potential. And so, as I mentioned before I started addressing this point, this is the polar opposite of the valuation mania, right? On one end, you've got these companies that raise more money than they need, and all they're doing is burning money. On the other end, you've got companies that are founded by startups that may be inexperienced, that may be unrealistic, that perhaps haven't got as much money as necessary to really get their enterprise going. Oftentimes, I've come across cases where some of these companies haven't even got enough money to develop their product, right? They're halfway into developing their product, and they're calling upon investors for a little more money, and things don't work that way. Okay, you've got to be very diligent in terms of planning your idea, in terms of planning your approach before you get started. Sure, you're going to have to improvise, you're going to have to learn along the way, no doubt, right? There's no denying that, but you also don't want to be too rushed. Don't want to be too naive in terms of what it actually costs in terms of time and money and experience to really get a startup or a company going. Having addressed both these wrong approaches when it comes to financing a startup or a small business, the obvious question then is, well, what's the right approach, right? And I know this because I've done this talk before at a couple other instances. And so, but an obvious question to ask here is, well, what is the right approach? And so the right approach really depends on various different factors, what industry you're in, and what sort of a product you got. Really a few different factors, but broadly speaking, as I've mentioned, you want to make sure that you really plan things out well. You want to make sure that the model you have in mind is economically viable, right? It is a legitimate business that would make you money. And so you want to have the right knowledge, the right education. You want to have the right experience. So how does one go about fulfilling both these requirements? Well, very simple in terms of education. Enroll yourself in the right course, the right degree, all of that, right? And in terms of the right experience, go work for someone that you look up to in the industry that you want to be in, right? If you're a student that wants to be in the F&B industry, the hospitality industry, or you've got a great product idea or a software idea, an application idea, go work for someone that has performed exceptionally well in that space, right? While you're pursuing your degree, do internships with them, work for them, right? Get to know the right people, get to know the business, the industry, operationally speaking, right? Understand all of those critical aspects. And if you know, these are of course a few pointers that you can keep in mind. For me to address this in detail might take far too long. You all might be here for several hours on end, but really in brief, these are a few things that you want to do. All right, so I think that sums up my talk as far as having realistic expectations and a realistic approach, a very logical approach as far as the financials of your startup and small business are concerned. I do believe we've got a Q&A session now, so if you've got any questions about my topic or the previous talks that you all have witnessed, please feel free to bring up those questions. Once again, it has been a pleasure and an honor sharing this panel with Mr. Andreas, Mr. Raj, and Mrs. Anju. And yeah, I look forward to some good questions.